Here's what just hit your mailbox, and most folks are throwing it in the trash without realizing they're leaving thousands of dollars on the table. Starting today, the IRS has officially rolled out a brand new $6,000 tax deduction specifically for Americans age 65 and older, and if you're married and both of you qualify, we're talking $12,000 that can come straight off your taxable income. Now here's where this gets real interesting for those of you collecting Social Security. The average retirement benefit went up $56 a month this January. Sounds great, right? But Medicare Part B premiums jumped almost $18, which means your actual increase is closer to $38. That's the bad news. The good news? This new deduction could potentially wipe out federal taxes on your Social Security benefits entirely, depending on your income. If you're a single filer making under $75,000, or a married couple bringing in less than $150,000, you need to understand exactly how this works because the deduction starts phasing out above those numbers. And here's the kicker. This whole thing expires in 2028, which means we've got a limited window to maximize this benefit. The IRS isn't going to call you. Your tax software might not even flag it correctly. This is one of those situations where knowledge literally pays, and ignorance costs you real money. Now look, I've been doing this for over 30 years. And I can tell you right now that most Americans have absolutely no idea how their Social Security gets taxed. None. They think the government's just going to send them a check every month, and that's that. But here's the reality. And I'm going to walk you through this step by step because understanding this is the difference between keeping your money and handing it over to Uncle Sam for no good reason. Let's start with the basics, because this is where everybody gets confused. If you're single and your combined income comes to more than $25,000, then part of your Social Security benefits may be taxable. Now, what the heck is combined income? It's not just your Social Security check. Combined income is your adjusted gross income plus any tax-free interest you're earning, plus half of your Social Security benefits. So if you're pulling money out of a traditional IRA, if you've got a pension, if you're still working part-time, all of that counts. And here's the kicker that drives me absolutely crazy. Those thresholds of $25,000 for singles and $32,000 for married couples, those haven't changed since 1984. Think about that for a second. We've had inflation for over 40 years. Wages have gone up. The cost of everything has skyrocketed. But Congress has left those numbers frozen in time like they're in some kind of financial ice age. What this means in real life is that more and more retirees are getting hit with taxes on their Social Security every single year. Back in 1984, less than 10% of beneficiaries paid federal income tax on their benefits. Today, we're looking at more than half of all Social Security recipients paying taxes on at least some portion of their benefits. That's not because people are getting richer, it's because the government changed the rules and then never adjusted them for inflation. It's one of the most insidious stealth tax increases in American history, and hardly anybody's talking about it. Here's how the taxation actually works. And stay with me because this gets a little wonky, but it's super important. If your combined income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple filing jointly, then up to 50% of your Social Security benefits become taxable. Notice I said become taxable. That doesn't mean you're paying 50% in taxes. It means that 50% of your benefit gets added to your taxable income, and then taxed at whatever your regular tax rate is. But if your combined income goes above $34,000 for singles or $44,000 for couples, now we're talking about up to 85% of your Social Security becoming taxable. 85%. So you paid into this system your entire working life. The government took money out of every single paycheck you ever earned, and now they're turning around and taxing you again on the money they're giving back to you. It makes my head want to explode. Now here's where this new deduction comes in and why it's such a big deal. This $6,000 deduction, $12,000 if you're married and both of you are 65 or older, this is a game changer for millions of Americans. Think about it this way. Let's say you're a single person pulling in $40,000 a year, total between Social Security and some IRA withdrawals. Under the old system, you're going to get hammered with taxes on your Social Security. But with this new $6,000 deduction, you just knocked your taxable income down by $6,000. That could be the difference between having 85% of your Social Security taxed and having maybe only 50% taxed, or in some cases, having none of it taxed at all. Let me give you a real-world example because I know some of you are sitting there thinking, Dave, how does this actually work for me? Let's say you're married. Both of you are over 65, and you're bringing in a combined $70,000 a year. That includes your Social Security, maybe a small pension, and some withdrawals from your retirement accounts. Under the old rules, a big chunk of your Social Security is getting taxed. But now, you take the regular standard deduction, which for married couples filing jointly in 2026 is $32,200. Then you add the extra standard deduction for being over 65, which is $1,650 per person, so that's another $3,300 on top. And then, this is the beautiful part, you get to take this new $6,000 senior bonus deduction for each of you, which is another $12,000 total. We're talking about a combined deduction of over $47,000. If you're bringing in $70,000 and you can deduct $47,000, you're only paying taxes on $23,000 of income. That's massive. But here's what you need to understand about this new deduction. It doesn't last forever. This thing is only good for tax years 2025 through 2028. It's temporary. Congress put an expiration date on it, which is the most frustrating thing in the world because we all know what's going to happen. They're going to let it expire, and then in 2029, we're all back to getting hammered with taxes again unless Congress gets off their rear ends and makes this permanent. So you've got 4 years to maximize this benefit, 4 years to really dial in your retirement income strategy and take advantage of every single dollar of deduction you can get. And speaking of strategy, let's talk about the income limits because this is where people start losing this deduction. The deduction phases out for taxpayers with modified adjusted gross income over $75,000 for singles or $150,000 for joint filers. What does phases out mean? It means if you make exactly $75,000 as a single person, you're starting to lose some of that $6,000 deduction. Make $80,000, you're losing more. The higher you go above that threshold, the less of the deduction you get to claim. This is why planning matters. This is why you can't just wing it and hope everything works out. You need to know where your income's going to land for the year, and you need to be strategic about when you take withdrawals from your retirement accounts. Here's something else that's flying under the radar that I want you to pay attention to. The average Social Security benefit went up about $56, $57 a month in January 2026 because of the cost of living adjustment. Sounds good, right? More money in your pocket, except Medicare Part B premiums also went up. And when you do the math, that premium increase ate up a chunk of that raise. Your actual increase in your pocket is probably closer to $38, maybe $40 a month. Now, that's still better than nothing. But here's the problem. Because your Social Security went up, that could push you over one of those taxation thresholds we were talking about earlier. So you got a tiny raise from Social Security, Medicare took half of it, and now the IRS is going to tax more of your benefits because your income went up. It's like you're on a treadmill that keeps speeding up and you can't get off. This is exactly why this new deduction is so critical. It gives you breathing room. It lets you absorb those cost of living increases without immediately getting punished with higher taxes. And for folks who are right on the edge of those taxation thresholds, this could literally be the difference between keeping hundreds or even thousands of dollars in your pocket every year versus sending it to Washington. Now let me talk to those of you who are still working because this affects you too. In 2026, the maximum amount of earnings on which you must pay Social Security tax is $184,500. That's up from about $176,000 in 2025. What this means is if you're a high earner, you're going to pay more in Social Security taxes this year because the ceiling went up. But here's the flip side. If you're 65 or older and still working, you can now take advantage of this new deduction while you're still earning income. You don't have to be retired to claim it. As long as you're 65 by the end of the tax year, you qualify. So, if you're one of those people who loves your job and you plan to work into your 70s, this deduction is available to you right now. Let me also address something I'm hearing from a lot of folks who are worried about whether they should even file a tax return. Here's the deal. If Social Security is your only source of income and you're receiving less than the standard deduction amount for your filing status, generally speaking, you don't have to file a federal tax return. But, and this is a big but, there are situations where you should file even if you're not required to. Maybe you had taxes withheld from your Social Security or from a part-time job. If you file, you might get that money back as a refund. Or maybe you qualify for certain tax credits that could put money in your pocket. The point is, don't just assume you don't need to file. Talk to a tax professional. Get somebody who knows what they're doing to look at your situation. And while we're on the subject of tax professionals, let me say this. If your tax situation is anything more complicated than just a Social Security check and maybe a simple pension, you need professional help. I'm talking about if you've got rental properties, if you're doing Roth conversions, if you've got capital gains from selling investments, if you're juggling multiple income sources. Get somebody who knows the tax code to help you. This new deduction, combined with all the other rules around Social Security taxation and required minimum distributions and everything else, it gets complicated fast. And the cost of screwing this up is way more than the cost of hiring somebody who knows what they're doing. Here's another piece of this puzzle that people aren't thinking about. A lot of you have money in traditional IRAs and 401ks. Every dollar you pull out of those accounts counts as ordinary income. It raises your combined income, which can make more of your Social Security taxable. This is where Roth IRAs become incredibly valuable in retirement. Money you pull out of a Roth IRA, that doesn't count toward your combined income for Social Security taxation purposes. Zero. Zilch. It's invisible to the IRS as far as Social Security taxation goes. So if you're sitting there in your 50s or early 60s and you're thinking about doing Roth conversions, this is one of the reasons why it can make sense. You pay the taxes now while you're still working and in a known tax bracket, and then later when you're retired and trying to manage your income to minimize taxes on Social Security, you've got this pot of money you can pull from that doesn't mess up your tax situation. Now, I know some of you are thinking, Dave, this is a lot to keep track of. How am I supposed to remember all these thresholds and phase-outs and deductions? And you're right, it is a lot. This is why you need a plan. You need to sit down, preferably with a tax professional and a financial advisor who actually knows what they're doing, and you need to map out your retirement income strategy. When are you going to claim Social Security? How much are you going to pull from your traditional retirement accounts each year? Are you going to do Roth conversions? How much room do you have under these various thresholds before you start losing deductions or getting hit with higher taxes? All of this stuff works together, and you can't just make it up as you go. Let me give you one more reality check here. The government is broke. Social Security is heading toward a funding crisis. Medicare is heading toward a funding crisis. The national debt is out of control. And you know what that means? It means Congress is going to be looking for every possible way to squeeze more tax revenue out of people. They've already shown us they're willing to tax Social Security benefits, something that was supposed to be a safety net for seniors. They've shown us they're willing to freeze taxation thresholds and let inflation silently push more people into higher tax brackets. So when they hand you a gift like this $6,000 deduction, you better believe it's not going to last. You've got 4 years. Use them wisely. Maximize every dollar of deduction you can get, because I promise you, when 2029 rolls around, this deduction is probably going to be gone unless there's a massive public outcry to keep it. And finally, let me say this to everyone listening. You worked your whole life. You paid into Social Security every single paycheck. That money belongs to you. The government shouldn't be taxing your Social Security at all as far as I'm concerned, but that's a rant for another day. What I want you to focus on right now is protecting what's yours. Understand these rules. Use this deduction. Don't leave money on the table because you didn't know about it or because you thought it was too complicated to figure out. The IRS is not going to call you up and tell you you're missing out on a deduction. They're perfectly happy to take your money if you're too uninformed or too lazy to claim what you're entitled to. But that's not you, because you're here, you're listening, you're learning, and you're going to take action. This is your money. Act like it.